Hello everyone, in this video we would be beginning with chapter number 3 of CMT level 2, which is moving averages. So a little bit of moving averages before we begin is that you all must be familiar with it already because this was a major part of the CMT level 1. So I will not be going into the extreme detail of it because I am assuming that you know the basics of it, even though we are going to completely complete and cover every single concept which is there regarding moving average in this textbook. But I would advise you guys to go to my CMT level 1 playlist and watch the moving average video because a lot of the concepts are similar. So it would be great if you guys could first brush up that concept. Okay, so moving average. What exactly are moving averages and why do people use it? If you go on any chart, let's say right now I'm opening my crude oil chart. Okay, so right now I also have a trade going on in crude oil, which is why it makes more sense if I use this chart. So I won't go into the detail of why I took this trade, but this is my ideology behind the trade. And I'm a little bit almost near to my target, so I'll book it the moment it reaches my target. Now, my bias is on the downside, right? My bias is on the downside. So if I go on the indicators and set a moving average, what will happen? If I set a simple moving average, you can see that this is how it looks. I can change the settings of the moving average to whatever number I want. So let's take 50 moving average since it's a very important moving average. So the line which is presented on the screen, that is what is known as a moving average. So what exactly is a moving average? In simple terms, you need to keep in mind that moving average basically is the it shows us the average, or it shows us what the average of the price is. For example, if it's a 50 moving average, it is going to show you the average price using the data of the past 50 candles. If it's a 100 moving average, it will show you the data using the past 100 candles. So the moving average basically is the average of the past prices. So by going into the settings, you can change the number as to how many candles price do you want it to see. For example, if I make a 22 moving average, you can see how the moving average slope has changed, right? So if I go on a clear chart where there is no analysis. So the learning objectives in this chapter, various types of moving average. So we know that there are various types of moving average. For example, the simple moving average, which we just saw. We have the exponential moving average. We have triangular moving average, and we have geometric moving average. Just a second, let me connect my Apple Pencil. Okay, so these are the various kinds of moving averages which can be used. Now we will also see that what are the uses of a moving average and how do you use the directional movement moving averages, and what are envelopes, what are channels and band indicators. So the first thing we need to know that identifying trend is the most important thing when it comes to trading, right? So you need to identify what trend is going on in the market. So when we use a moving average, the most important thing which the moving average tells us is about what direction the market is in currently. So by that I mean is the slope. So for example, if my moving average is rising in an upward momentum, like let's say it's rising like this, then I can say that my price is in a rising momentum right now, rising direction right now. So if there is my moving average slope is low, then I can say that the price is in a downtrend. And if I say that my moving average is in the same range, or if it's sideways, I can say that the market is very dry right now and I will not take a trade. So if we go on any stock, let's go to, let's say, Britannia. I'm just picking out a random stock and we will see the slope of the moving average and we'll try to identify. So right now I have the 22 moving average. So if you look at this part over here, we can see that my price, the moving average is rising and the price has also been continuously rising. So how do we know that? Because my moving average is also rising. So the moving average basically shows you a trend, how the market is going on. So for example, here the price is so choppy. You can see that the price traded in this particular range, and during that time you can see that the moving average was also sideways in one particular range. And the moment the price left this range and started going up, you can see that the moving average also changed its shape. So moving average will basically show you the trend or the direction. And why do we actually use moving average? It is to basically dampen the effects of short-term oscillations. So it is to basically smooth out the data and show you the data with a little bit of less noise. Now, less noise, that would also be very much, you know, it would be based on the moving average period which you are using. If you are using a 40 moving average, if you are using a 20 moving average, it all keeps changing, right? So changing directions. Moving averages are useful in markets that have a tendency to trend. So like we have seen in the examples, that when the markets are trending, then you can use moving averages. But when it is sideways or in a particular range, in markets like that, moving averages might not be very useful. Okay. With that being said, you need to also keep something in mind, that is that moving average methods might not be the best thing to use. Like, you can use it as a confirmation along with the other things you are using in trading, but moving average should not be the only thing which you are using while you're trading. So it can be used as a confirmation factor, but it can't be the only thing. So what exactly is a moving average? So you can see that moving averages are used to tone down these fluctuations. So it is to smoothen the erratic data, it is to tone them down, and it is for us to identify what the underlying trend is. Very simple. And you can see that the period of moving average which you are using, that can be of the time period which is important for you. Let's say I want to do swing trading, or if let's say I want to see the moving average of the past 50 candles, and I can use a 50 period moving data. Let's say I want to scalp, because of which I want to see only the last 2 candles, then I can use a 2 moving average. So that is basically dependent on my personal reasons, right? So speaking of simple moving averages, like, let me also go on chart and show you what we just have is a simple moving average. You can see SMA written. So here, I don't know how to circle it. Yeah, SMA is basically simple moving average. So simple moving average is very simple. It is just the basic average of the candles. Keep that in mind. So what price is taken? Like I just told you, that the average of price is taken. Now what is the price? Price means the closing price. So only the closing price is taken into account. So we are going to take the closing prices of the past 20 candles if I'm using a 20 simple moving average, and we are going to calculate the average of the past 20 days. Simple that. So very simple. This is just the data. They have just given you the data and nothing very important in that. This is the 10 days simple moving average. Price of the 10 days divided by 10. Price of the 26 days divided by 26. 10 LWMO. So this is the SMA. EMA is the exponential moving average. LWMO is the linearly weighted. We'll come to that. Now, one more name for simple moving average is the arithmetic moving average. So whenever they're talking about arithmetic moving average, you can just keep in mind that they are referring to as a simple moving average, right? So adding the set of data and then dividing by the number of observations. A basic average formula, that is the formula of simple moving average. Simple. So if let's say this is a moving average of 10 days, then data from 1 to 10 days divided by 10. Very simple. Don't get confused by looking at the formula. It is just a simple moving average, nothing confusing. Okay. So people really, there are few moving averages which are more famous and more used widely than the others. Like the 200 moving average, it is known as the golden moving average. 60, 50, 30, 20. So you can go and do this. So there's a very important thing which like few traders really use that. Like, so they usually, what they do is that, just a second, my net is not working. Yeah. So what they basically do is that they use a 200 moving average as a filter. And what really happens when they use a 200 moving average, they are just going to use it as a bias as to, let's say, the price of the stocks which are, so when the stock is trading above the 200 moving average, they will just assume that it is in an uptrend and they will only look for buying opportunities. And if the price is trading below the 200 moving average, then they will look for shorting opportunities. So you can see clearly the price is above the 200 moving average, right? So the price is above the 200 moving average, so we will only look for buying opportunities. Here, in situations like these, when the price is below the moving average, we will look for shorting opportunities. So that is also one thing which people use. So the daily fluctuations are smoothed out by the moving average. So why do they do that? So that the analysts can see the underlying trend and they will not get distracted by the small or the minute movements which don't really matter. They've given an example of the Walmart chart, and it is a 26-day simple moving average. So just what we've discussed. And if you think I'm going fast and if I'm not able to clear your doubts, please make sure to go on my CMT level 1 playlist, and there I've explained moving average in extreme depth. See, the reason you are now enrolled in CMT level 2 is because you have cleared the level 1. So I'm assuming that the concepts of moving average is very clear in your head. Okay, so rising moving average, you know what it is, upward, and you know that the falling moving average is a downward trend. All right. So one thing you need to keep in mind is the disadvantage of a moving average, that is lagging indicator. So it gives you an information about something that has happened in the past. So that is a little bit late. So the moving average changes the direction a little bit later than the price. So in that way we can say that it is a lagging indicator. So what happens when it's a lagging indicator? There will be a little bit delay, and that will basically that is the opportunity cost which you have to pay. Now, length of the moving average, we know what length we have to use depending on our style of trading, depending on how many periods of data we want to be included in our moving average. According to me, if I want a larger time frame, then I can use a larger moving average. So this is like that. Okay. And now you need to keep in mind that the larger data, basically when you use a larger period of moving average, then the change in the trend would be slow, right? So the changes will be, that will lead to a lot of delay, but it will also help you to not enter on false signals. When you are using a very extremely short moving average, then there'll be a lot of whipsaws, there'll be a lot of false entries and a lot of false signals. But you can also say that it'll be quick, you don't have to wait, and you won't be able to miss out on opportunities. So when you are choosing a period of moving average, you need to make sure that it aligns with your goals. By goals, I mean that it should align with the trading system you are following according to what is your particular time frame, and then you have to choose. So now we have the 26 moving average and 13 moving average. They have given you a figure 3.2. So look at this, there's a 26 and there is a 13 moving average. Now, by just looking at this picture, which one is 13, which one is 26? Can you see that? Can you identify that? The 13, this one is the 13. The one which is above, this one is 13. Now, one second, let me just highlight it with blue. This is 13. Now, why would I say this is 13? Because you can see here the price moved and it gave a downward movement over here, whereas this was going up. So we can see that the higher time frame will not shift very quickly, whereas the shorter time frame will give you quick movements. That is something to keep in mind. So you can see that this was not there in the higher time frame. So these kind of erratic whipsaws can be missed if you are using a higher time frame. So many successful moving average strategies use moving average as the principal determinant of trend. Okay, and then they use shorter moving averages for setting the trailing stop loss. So moving averages are used to determine the trend, and chart patterns are used as the entry and exit signals. So what they mean is that sometimes what I can do is, what I personally do in my trading is, my trades are not based solely on moving average. What I do is I use a moving average to see what trend or what direction is the price going in overall. And if I think that the moving average is rising, then I will look for my rising opportunities. Now me personally, I will not just look at only moving average and take a trade. I will combine it with other things. So that is one thing to keep in mind. So dual moving averages, so people also use dual moving averages. That means you are having two moving averages and then you are taking a trade in like crossovers and stuff like that. So when both of the moving average cross together, you enter. I think you all know this. But the thing is, if you are in a sideways market, then the prices might keep crossing each other, but that will just lead to whipsaws, because the prices might be crossing each other, but then the price will not go anywhere because the market is in a sideways momentum right now. So those are the kind of things which can happen. So if you look at this is what is a crossover signal. So whenever the crossover is happening, you're either buying or you're selling. If the smaller moving average crosses the bigger moving average from down to up, then you will buy. If it's vice versa, then you will sell. If the market is in a sideways place, then you will basically have a stop loss. For example, here there is a sell. Now it says sell, but what happened after that? The price went up. So this will basically give you a stop loss. So those are the kind of disadvantages which can happen. So that is why I'm saying whenever you are using moving average, make sure to use other confirmations as well. Or primarily use the moving average only as a trend indicator. It will show you which direction the market is in. From there on, you can use your own strategy and do that. So what are the types of moving average which we use? So what we just saw was the simple moving average. Other than simple moving average, there are various other kinds of moving average which are there in the market. So what is the problem with simple moving average? If you think about the simple moving average, we can see that by, let's say, it's a 20 moving average, then the point in the average is basically showing us the price of the previous 20 candles average, right? Now when I go to the next day, the initial first day from this 20 will get dropped off and the new day will be added. So this drop off effect of the initial day has been causing a problem. This dropping of the earliest price figure is basically not giving us efficient results. So here what the problem is that equal weight is given to each of the day. So all the 20 days if I'm using a 20 moving average, all the 60 days if I'm using a 60 moving average, all of them have the same particular weightage. Now this is a little bit problematic. So because of which people started wondering and learning about how to basically let go of this particular problem, that all the price of every single day is given in equal weightage and thus dropout effect, because of which what they did is they came up with something else that is known as a weighted moving average. Now what exactly is a weighted moving average? The most recent day is given more weight as compared to the previous day. Keep that in mind. So the recent data is given more weight as compared to the previous data. So why was weighted moving average invented in the first place? It was invented because of the drop-off effect and the equal weight effect which the simple moving average had. To counter that problem, weighted moving average was came into picture. Now weighted moving average basically gave more weightage to the recent data. Coming to linearly weighted moving average, again, if you are wondering about how to set the weighted moving average, just go here and type weighted moving average. You will get it. Moving average weighted. So you can just do that. And the recent data would be given more weight. And make sure to actually, after watching this lecture, make sure to yourself go and check on TradingView or any other software, because you need to be clear about how to practically use this. Because if you don't know how to practically use this particular indicator, then you might not be able to score marks, because this is not only about the exam, but it's also about you being a good trader in life, right? Okay. Now let's discuss quickly the linearly weighted moving average. Now there are a little bit of formulas and you need to learn the formulas, because in the exam formulas are tested. So now that is one thing which you have to do by yourself. I would explain all the formulas to you and I would make you guys learn in the video itself, but then you need to take the pains and you need to do your own bit in making the notes of the formulas and in revising the formulas, pausing the video as and when and revising the formula over and over again. So that is your thing. So linearly weighted moving average. So when we talk about a 10-day linearly weighted moving average, so it multiplies the 10th day observation by 10, the 9th by 9th, 8th by 8th. So every day's observation is multiplied by the number of day, and then it's going to be divided by, and it's then going to be added and then divided by the sum of all the multipliers. Simple. So how are you going to calculate the linearly weighted moving average? Very simple. Every single observation is multiplied by the number and then it's added up, and the sum is basically divided by the sum of all the multiples. Simple, very basic. So what happens in linearly weighted moving average is that the most recent data is given twice the importance of the day 5. So keep that in mind. Oops, just a second. Yeah. Next we have is the exponentially smoothed moving average. What exactly is an exponentially smoothed average? Now this is also one really, just a second. This is also one really very fondly used moving average, I must say, a lot of traders use EMA instead of SMA because that suits them better. But if you actually go and plot both of them, you can see that the EMA and the SMA are just differing slightly. Otherwise, more or less, they both go together only. So you can see that. Now, you can think about it. The same problem with a linearly weighted moving average, which we saw, and the SMA, the dropping off effect. Now, in linearly weighted moving average, the latest data is given more weight, agreed. But then it's still dropping off the initial day, right? It's dropping off that. So that is something which is still causing a problem. Even though the linearly weighted moving average solved the problem of the fact that the previous day or the previous, like, the weightage of the previous days is more as compared to the initial days. But then there was still a drop off effect, because of which people started using the EMA. EMA is the exponentially moving average. Now, this basically took care of the drop off effect. Now, the large change in the moving average results from the deletion of the early data, right? So, the deletion of the early data was something which was looked and taken care about. And here, what they did is older information was also there when you are calculating this. And this is the formula which they used: 2 divided by number of the days in the moving average plus 1. Now, by using this, they were able to give less importance, but they did not drop off the previous thing. Now, this is another formula. Weight of the moving average is equal to 100% minus weight of the current. So, current is basically, like we are talking about, if I'm calculating it right now, that is current. Keep that in mind. And this is one more way of how they calculate EMA. You don't have to learn this particular formula, but you need to know what exactly EMA does and what it basically, which problem it was taking care about, the drop off effect. And the weight of the current, what is the weight of the current? Weight of the current is equal to 2 divided by number of days in the moving average plus 1. Now, that is my EMA. And you can also, EMA is one thing which is used in many of the indicators as well. Now, there's a thing which is known as the McKellen index. A McKellen index is a very popular indicator used by many people. And in the McKellen index, they use two moving averages. And they particularly use moving averages which are exponential. That is exponential moving average. So, a 19-day moving average and a 39-day moving average. A 19-day moving average and a 39-day moving average. These two moving averages, exponential moving averages, are used in McKellen index. So keep that in mind. So the 19 EMA has a smoothing factor of 0.10 and the 39 EMA has a smoothing factor of 0.05. So these calculations are basically used. And even in MACD. Even in MACD it is used. Now you have to keep in mind that the prices which are more recent, they are given more weight, and the previous are not dropped off rapidly, right? Because of which it is known as exponential moving average. So McKellen index, smoothing, you should remember the smoothing, 0.10 and 0.5, and 19 and 39-day moving average. Very simple, basic stuff. Like, if you actually listen to what I'm saying, you'll be done with this chapter by the end of this video. So yeah, look at this. They've just plotted the moving average. Alright, and then we'll have the Wilder method. Now, what exactly is Wilder? Now, if you have done the previous chapter, then you will know that Wilder is one person which has been very widely referred to whenever we are studying, right? So Wilder has invented his own moving average, or how to basically use the moving averages. Now, what exactly that Wilder do is that Wilder has created his own particular formula. Now, Wilder has basically given moving average, and it is used in average true range. You know an indicator ATR, you must have learnt about the indicators ATR, RSI, DMI, right? In these indicators, the moving average which is used is the Wilder's moving average. Now, Wilder has given this formula which he is using. Moving average of the day I is the day or the period, n minus 1 multiplied by moving average I minus 1 plus price of the day I divided by n. Now, what exactly this is? So, if you think about it, a 14-day Wilder moving average would be equal to the previous day's moving average. So day I is 14. 14 would be n minus 1, which is 13, and plus the current closing price. This is the closing price. So keep that in mind. Wilder's moving average is the moving average which is basically used in RSI, ATR, DMI. You need to keep that in mind, okay? And whenever you're using charting softwares, you need to make sure that whenever you're using these indicators, Wilder's moving average should only be included, because if you're not using Wilder moving average and you're using ATR and it is using some other moving average, then your results will be incorrect. So that you need to keep in mind. Now we have the geometric moving average. Now geometric, whenever you think about geometric moving average, you need to keep in mind that it is used in indexes. Whenever you are using indices, or whenever you have to use in any index, geometric moving average is used the more, and this is something you need to keep in mind. That's it. Next we come to triangular moving average. So whenever the word triangular moving average comes to your mind in the exam, just know that it gives you a doubly smoothed moving average. So first they find the moving average, and then they find the moving average of the moving average itself. So that will give you a double moving average. So this double moving average is basically a triangular moving average. So when you double, which means you're smoothing it even more, that will basically give you a better trend. Okay, keep that in mind. Alright, then we have the variable EMAs. Now what is variable EMAs? So variable is basically that you are taking into account volatility of the price. When you're taking into account the volatility of the price, then the EMA changes, right? So that is what is said in variable EMAs. Okay, the Mama Pharma, this is a very basic stuff. This is covered in my CMT level 1 again. If you want, you can pause the video and read it, but it won't be tested. Okay, then we come to the strategies of using moving average. The first thing is determining trend. Now what do we understand by determining trend? We've discussed in the starting of the chapter that by looking at the moving average visually, we know what trend is going on. If the moving average is rising, we know that the trend is upward. If it's falling, we know trend is downwards. Now if you look at this, there is a trend line and there is a moving average. This is the just a second. We can see that this is a moving average and this is a trend line. We can see more or less the trend line and the moving average move the same way, right? So that is something you need to keep in mind. And most of the time, moving average also act as a support or a resistance. Look at this. Look at how the price basically took support at the moving average and went up. So you need to also understand that the moving average can act as a support or a resistance as well. Like here also it came down, took support near the moving average and went up again. So that is the second point. And then we have the determining price extremes. Now what exactly is price extreme? See, what is moving average? Moving average is mean, right? And whenever the price is very far away from the mean, then we can be sure that the price will for sure come back near the mean, right? It has to come back near the mean. That is what is known as mean reversion. For example, the price went far from the moving average. It went till here. And we know that the price has to come back to moving average, and then we see that the price actually comes back to moving average. So this is basically a price extreme. So price extremes can also be identified. Then what we have is giving specific signals. So we also know that by combining it with other particular indicators or our own strategy, it can give you signals as well. Now by signals, we can also take into account the crossover strategy or the other strategies like that which can be used. Now, however, it's not ideal for you to use only moving average, but it can be used as a confirmation thing. Okay, so I'm stopping this video over here. So make sure to sink in the information which you've learned in this video in the next video, which I'll be uploading in tomorrow itself. There we will be studying the directional movement and we'll be finishing the chapter. Thank you.